Ever wondered when a company actually gets to say it's earned its money? Sounds simple, maybe, but in business, it's a surprisingly intricate dance. So today we're taking a deep dive into the, well, sometimes complex world of advanced revenue recognition. We waded through a bunch of sources on revenue recognition advanced topics, and our mission really is to cut through the jargon for you. We want to pull out the most important bits, give you a shortcut, so you're really well informed. We'll explore when and how companies record their earnings, especially in those tricky situations. Okay, let's unpack this. All right, first things first. Let's lay the groundwork. What is revenue recognition at its core? Our sources define it pretty clearly. It's when a company delivers on its promise. They call that a performance obligation by transferring a good or service to a customer. And the really crucial part, the revenue recorded has to reflect what the company actually expects to get in return. It's all about matching earnings to delivery.
That's the heart of it, yes. And, it's not just for the huge public companies, which is a common misconception. What's key here is that this standard applies to basically all kinds of entities, public, private, even not-for-profits, if they have contracts with customers to transfer goods or services. Of course, there are some specific carve-outs like leases, insurance, certain financial instruments. They have their own rule books.
Okay, so it's pretty wide-reaching then. Now, our sources talk a lot about this five-step approach.
Yeah.
Sounds like the core framework.
It absolutely is. Think of it as the practical roadmap companies have to follow. It's not just theory.
Right, a guide to getting it right.
Exactly. It ensures accuracy, transparency. So let's walk through them quickly. Step 1, identify the contract with the customer. Seems obvious, but you need that clear, enforceable agreement first.
Makes sense. Foundation.
Step 2, identify the separate performance obligations. A single contract might bundle multiple promises, right? Like selling software and including a year of support. Those are two distinct promises, two performance obligations.
Got it. Break down the promises.
Step 3, determine the transaction price. Basically, how much money do you expect to get? Could be fixed, could have discounts, bonuses, that sort of thing.
Okay, the total pot of money.
Step 4, allocate that transaction price. If you have multiple promises from step 2, you need to split the total price among them. Usually that's based on what each thing would sell for on its own, the standalone selling price.
A fair share for each promise.
And finally, step 5, recognize revenue when or sometimes as the company satisfies each promise. This is the trigger point. You book the revenue when you've actually done the work or delivered the goods. And this whole structured approach, it really matters. You might ask, why all this detail?
Yeah, why is it so important for a company's health?
Because it gives everyone, investors, lenders, you name it, a clear, reliable picture of how the company is actually performing. Are they making money? When? It's fundamental.
That really underscores the precision needed. And speaking of precision, long-term construction contracts, those are a classic example of where this gets really complex.
Oh, definitely. Big projects, long timelines.
The sources highlight two main ways to handle these. Recognize revenue over time as you build, or wait until the very end at a point in time. Seems like a huge decision.
It is a huge decision.
Yeah.
And you recognize revenue over time only if you meet certain criteria. One key condition is if your work creates or enhances an asset like a building under construction that the customer controls as it's being created or enhanced.
So like building a custom house where the buyer makes progress payments and essentially owns the work as it goes up.
Exactly like that. Or, alternatively, if the thing you're building doesn't have an alternative use, meaning you couldn't easily sell it to someone else, it's very specific, and you have a right to get paid for the work you've done so far, even if the customer cancels.
Okay, so either the customer controls it as you build, or it's custom and you have a right to payment for work done.
Precisely. If either of those conditions is met, you can recognize revenue gradually over time. Let's make that real. Example 1. Tanner Co. builds residential complexes. They sign a contract for one specific unit. Customer pays a non-refundable deposit, makes progress payments. If the customer defaults, Tanner gets all the consideration if they finish the unit. And crucially, Tanner cannot redirect that specific unit to another customer.
Right. So in this case, Tanner satisfies its obligation over time.
Why? What's the key?
The key is twofold. First, because Tanner contractually cannot sell that unit to anyone else, it has no alternative future use for Tanner. And second, because of the payment terms and the inability to redirect, the customer is effectively controlling the asset as it's being built. So Tanner recognizes revenue as they incur costs and make progress.
Okay, that makes sense. So if it is over time, how do they actually calculate the income each year?
Well, assuming the contract is profitable, they usually use an input method. A common one is cost to cost. You basically figure out the percentage of completion by comparing the costs you've incurred so far to the total estimated cost for the whole project. Okay, like if we've spent $30 million out of an estimated $100 million total cost, we're 30% complete.
Exactly. Then you take that percentage, 30% in your example, and multiply it by the total estimated profit for the entire contract. That gives you the total profit earned to date.
And the profit for this year is just the profit earned to date minus whatever profit you'd already recognized in prior years?
You got it. It's cumulative. Now, on the balance sheet, it gets interesting too. You track the costs incurred plus the recognized profit in an account called construction in progress, or CIP. Think of it like inventory for that specific project.
Okay, CIP includes costs and the profit earned so far for overtime.
Right. And you also track progress billings. That's how much you've actually invoiced the customer. Then for reporting, you net these two. If CIP is bigger than billings, you have an asset you've earned more than you billed. If billings are bigger, it's a liability you've billed ahead of the work earned.
Got it. CIP versus billings tells the story.
Now, here's a really critical point for overtime contracts, and actually for point in time too, as we'll see. If at any point the company estimates that the entire contract will result in a low assess.
Uh-oh.
Yeah, they have to recognize that entire estimated loss immediately. In the year, they figure it out, no waiting.
Wow, the whole loss.
Yeah.
Even if they recognize profits in earlier years.
Yes. You essentially reverse any prior profit and book the full expected loss right away. It's a very conservative approach, reflecting bad news quickly.
Okay, that's a big rule. But what if a contract doesn't meet those overtime criteria we talked about?
Right. If it doesn't meet the criteria, maybe the customer doesn't control the asset as it's built, or the company could sell it elsewhere, or they don't have that enforceable right to payment for work done.
Then what?
Then you switch gears. Revenue is recognized at a point in time.
Meaning only when the whole thing is finished.
Exactly. No revenue and crucially no profit is recognized until the contract is complete and control of the asset, like the finished building, is transferred to the customer.
Let's use Canico again, example 2. Same complex but different terms. This time, the customer's deposit is refundable if Tanner fails to complete the unit. The rest is only due on completion. And if the customer defaults before completion, Tanner only keeps a deposit, not payment for all work done.
Okay, see the difference. Here, Tanner's obligation is satisfied at a point in time.
Why the switch?
Because the customer doesn't really control the unit as it's being built, the terms are different. And crucially, if the customer defaults, Tanner doesn't have an enforceable right to payment for all the performance completed to date, just that deposit.
Ah, okay. That right to payment for work done seems key.
It often is. So Tanner waits. Revenue and profit are recognized only when the unit is finished and handed over.
So how does the accounting differ during the construction period for point in time?
The balance sheet looks similar. You still track costs in CIP and you still track progress billings. But the big difference is inside the CIP account. For point-in-time contracts, CIP contains only the costs incurred. There's no estimated gross profit added to it along the way.
Because you're not recognizing profit yet.
Precisely. Profit waits until the end. However, and this is important.
Let me guess, the loss rule still applies.
You got it. Just like with overtime contracts, if you anticipate an overall loss on the entire contract, you must recognize that loss immediately and in full in the year you discover it.
So loss recognition is immediate for both methods, but profit recognition timing is the big difference.
That's the key takeaway. Overtime recognizes profit gradually. Point in time waits until completion. But losses, always recognized immediately.
Let's quickly run through example 3, the comparison.
Yeah.
Say we have a 4-year contract. Year 1 and 2 look profitable based on estimates. Overtime recognizes some profit each year. Point in time recognizes 0 profit. Costs just accumulate in CIP.
Correct.
Year 3, disaster strikes. Estimates change. Now we expect an overall loss on the whole contract.
Okay, critical moment. For both methods, overtime and point in time, that entire estimated loss gets recognized in year 3.
Even for the point-in-time method that hadn't recognized any profit yet.
Yes. You book the full anticipated loss. For the overtime method, you'd reverse any profit recognized in years 1 and 2 and then book the remaining estimated loss. For point in time, you just book the full estimated loss against the costs already in CIP.
And then year 4, the contract finishes.
For overtime, you'd recognize any final adjustment to profit or loss. For point in time, if the contract did end up profitable overall, despite the scare in year 3 maybe, that's when you'd recognize the full profit. If it ended in a loss, you recognize any remaining bit of that loss.
Wow. Okay, that really clarifies the difference, especially with that immediate loss rule. So the journal entries during construction would reflect this.
Absolutely. For overtime, you'd see entries during construction, debiting CIP and crediting revenue, or realized gross profit, as profit is recognized. For point in time, you'd just see costs accumulating in CIP, no profit entries until the very end, unless there's a loss to record.
Okay, that's a serious deep dive into construction. But revenue recognition isn't just about buildings. What are some other tricky areas?
Oh, plenty. The principles apply broadly. Let's touch on a few common ones. First, incremental costs of obtaining a contract. These are costs like, say, sales commissions you only paid because you won that specific contract.
Costs you wouldn't have spent otherwise.
Exactly. If you expect to recover these costs through the contract revenue, you don't expense them right away, you capitalize them.
Meaning, treat them like an asset on the balance sheet.
Yes, and then you amortize that asset, spread the cost over the life of the contract, matching it with the revenue. If you don't expect to recover them or they weren't truly incremental, then you expense them as incurred.
Okay, example 4. Software developer wins a contract. They spent $20K on travel to pitch, $10 on legal fees for the contract, and $12K in sales commissions.
Right. The $20K travel is likely expensed. You spent that trying to get the deal, win or lose. But the $10K legal fees and $12K commissions, those are directly tied to winning this contract.
So those are incremental.
Yes. Assuming the contract revenue will cover them, the developer would capitalize that $22K, $10 plus $12K as an asset and amortize it.
Got it. What about costs to fulfill a contract? Costs incurred after you win.
Similar idea. You can capitalize these if they relate directly to the contract, if they generate or enhance resources you'll use for it, like specific materials or software licenses bought for this job, and if you expect to recover them.
But not general costs.
Right. General admin, selling expenses, wasted materials, those are usually expensed. It has to be tied directly to fulfilling that contract and creating value for it.
Example 5. Same developer buys an $8 special workstation just for this contract's support. They also assign an existing employee, salary $30, to spend 10% of their time on it.
The $8 Keller workstation, that's capitalized. It's a specific resource, generates future value for this contract, relates directly, expected to be recovered.
And the employee's salary portion.
That $30K salary, even the portion allocated, is generally expensed as incurred. It's part of ongoing operational payroll cost. It doesn't typically create a new or enhanced asset for the company itself beyond just performing the work.
Okay, subtle distinction there. What about contract modifications? When deals change?
If a change significantly increases the scope with distinct new goods or services, and the price increases by an amount reflecting their standalone selling prices, you might treat it as a whole new contract.
And if not?
If it doesn't meet both those criteria, it's usually handled as an adjustment to the existing contract, impacting future revenue recognition under that original deal.
Makes sense. Now, principal versus agent. This comes up a lot, right? When there's a middleman.
All the time.
Yeah.
You have to figure out, are you the principal controlling the good or service before it gets to the end customer, or just an agent arranging the sale for someone else?
And the difference matters for revenue.
Hugely. The principal recognizes the gross amount of revenue, the full selling price. The agent only recognizes their net fee or commission.
What are the indicators of being a principal?
Key things include being primarily responsible for fulfilling the promise, having inventory risk, like owning the goods before they're sold, or having discretion in setting the price. If those point to you, you're likely the principal.
And an agent.
An agent typically isn't primarily responsible, doesn't hold inventory risk, and doesn't control the pricing. They're more like a facilitator.
Example 6. Anderson Co. sells a custom excavator to Tanner Co. for $385K. Anderson pays a separate manufacturer $350K to build it to spec. Anderson is responsible for specs and errors, though Tanner goes to the manufacturer for defect remedies. Principal or agent?
Anderson sounds like the principal here. Even though they use a manufacturer, Anderson is responsible for the overall promise to deliver the specific excavator to Tanner. They bear specification risk, and crucially, they set the final price to Tanner.
Okay, control is key. Now, repurchase agreements. Selling something, but maybe having to buy it back.
Yes, these are tricky. You sell an asset, but there's an obligation or an option to repurchase it later. Is it really a sale? It depends. If you have a forward or call option, meaning you have the obligation or right to buy it back, You look at the repurchase price.
Compared to the original selling price.
Exactly. If the repurchase price is less than what you sold it for, it often looks like a lease. The customer is essentially just using it for a period. But if the repurchase price is equal to or greater than the original selling price, it's usually treated as a financing arrangement.
Like a loan.
Basically, yes.
Okay.
You got cash, but you might have to give it back plus some extra to get the asset back. So you record the cash received as a liability, not revenue.
Example 7. Anderson sells an excavator for $350K cash. They have a call option to repurchase it later for $385K. The option lapses unexercised at year-end.
Okay, repurchase price $385K is greater than original selling price $350K. That signals financing arrangement.
So what happens?
Anderson records the $350 cash, but also a financial liability for $350K. During the year, they accrue interest expense on that liability, increasing it towards the $385K repurchase price. When the option lapses unexercised at year-end, then they remove the liability from their books and finally recognize the $385K as revenue. The sale effectively happens only when the repurchase possibility goes away.
Wow, okay. What about a put option, where the customer can force you to buy it back?
That adds another layer. You have to consider if the customer has a significant economic incentive to exercise that put option.
Meaning, is it a good deal for them to sell it back to you?
Right. So if the repurchase price is less than the original price and the customer has an incentive, maybe the repurchase price is higher than the expected market value at that time, it might be a lease. If the repurchase price is equal to or greater than the original price and it's higher than the expected market value, giving them incentive, it could be a financing arrangement. But if the customer doesn't really have an incentive to exercise the put option, maybe the repurchase price is below market value, then it might be treated as a sale with a right of return.
Okay, let's try example 8. Anderson sells for $350K. They are obligated to repurchase, if Tanner requests, for $350K. The expected market value then is only $275K.
All right. Repurchase price, $315K, is less than original price, $350K. Does Tanner have an incentive to exercise?
Well, they can get $315K back from Anderson, but the market value is only $275K. So yes, they'd want to sell it back to Anderson.
Exactly. Significant economic incentive. Repurchase price less than original price plus incentive. That points strongly towards lease accounting. Anderson hasn't really made a sale here initially.
Complex. Okay, shifting gears slightly. Bill and hold. Billing now, delivering later.
Yes. Generally, revenue is recognized when the customer gets control. For bill and hold, you can only recognize revenue before delivery if strict criteria are met.
Like what?
The reason for the arrangement must be substantive. For example, customer requested it. The product must be identified separately as belonging to the customer. It must be ready for physical transfer now, and the company cannot be able to use it or sell it to someone else.
All 4 conditions needed.
Yes, all must be met to recognize revenue before delivery.
Example 9. Anderson sells Tanner an excavator and spare parts. Tanner takes the excavator July 1st, pays for both, but asks Anderson to store the parts. Tanner lacks space. Tanner inspects and accepts the parts. They're ready. Anderson can't use them. Anderson will store them for 3 years, providing custodial services.
Okay, 3 distinct promises here.
Yeah.
Excavator, parts, custodial services.
Revenue for the excavator.
Recognized July 1st when Tanner takes control.
Revenue for the parts.
Also recognized July 1st. Why? Because all the bill and hold criteria are met. Substantive reason, Tanner requested. Parts identified, ready for transfer. Anderson can't use them. Tanner effectively controls them, even while stored.
And the custodial services.
That revenue is recognized over the 3-year storage period as Anderson provides the service.
Got it. What about consignment? Like goods held by a dealer?
Right. If a dealer or distributor holds your product but hasn't really obtained control yet, it's a consignment arrangement. You, the manufacturer, don't recognize revenue until the dealer actually sells it to an end customer or until control otherwise passes, like after a set period.
Which shows it's consignment.
Indicators include you, the manufacturer, still control the product until sell it. The dealer doesn't have an unconditional obligation to pay you before they sell it, and you can require the product's return or transfer it to another dealer.
Example 10. FMC, a car maker, sends cars to a dealer. Title passes only when the dealer sells to a customer. Dealer pays FMC only when title passes. FMC can demand unsold cars back or send them elsewhere.
Classic consignment. FMC doesn't recognize revenue when the cars arrive at the dealership. They recognize it only when the dealer sells a car to a final customer. The dealer doesn't truly control the inventory before them.
Okay, nearly there. Warranties. Are they part of the product or a separate promise?
It depends. If the customer could buy the warranty separately, it's usually a separate performance obligation. You allocate some of the transaction price to it and recognize that revenue over the warranty period.
And if it's just a standard, legally required warranty?
If it's legally required or just assures the product meets its basic specs, it's generally not a separate performance obligation. Its cost is just part of the cost of goods sold. A longer warranty period might also suggest it's a separate service.
Finally, refund liabilities and right of return. Selling stuff people might bring back.
Right. Companies have to estimate expected returns. You recognize revenue only for the portion you expect to keep.
So not the full sale amount initially.
Correct. You also recognize a refund liability for the amount you expect to refund, and you recognize an asset representing your right to get the returned products back.
So if I sell $1,000 cash, expect $100 back in returns.
You'd record $1,000 cash in, but maybe only $900 in revenue, a $100 refund liability, and an asset for the cost of the goods you expect to recover. It's about showing the net expected outcome up front.
Phew. That is a lot of nuance.
Yeah.
Okay, so after navigating all that,
Yeah.
how does a company make sure its internal books actually match up?
You're talking about reconciliation, making sure the details match the summary.
Specifically, the sales subledger versus the general ledger.
Exactly. The sales subledger has, every single transaction listed out. The general ledger just has the total sales number for the period. And for the financial data to be reliable, those two must agree. The total from all the individual sales in the subledger has to equal the summary sales balance in the general ledger. It's fundamental for data integrity.
Okay, makes sense.
Yeah.
But why wouldn't they match? Especially with automated systems these days.
You'd be surprised. Things can still go wrong. Sometimes someone makes a manual journal entry directly to the main sales account in the general ledger, maybe for a correction, but it doesn't get reflected down in the subledger details. That needs fixing.
Manual errors?
Or you might have month-end adjusting entries in the general ledger, maybe for accrued revenue that haven't been pushed down or allocated to the subledger records yet. So the subledger needs an update.
Timing differences.
Yep. And sometimes plain old system errors. Maybe a transaction got automatically posted to some miscellaneous income account instead of sales revenue. You need to fix the transaction and maybe the posting rule in the system.
Glitches happen.
They do. And finally, sometimes it's not an error, just a difference in presentation. Maybe discounts or allowances are netted directly against sales in the subledger, but they're shown in separate contra revenue accounts in the general ledger.
So the total sales line might not match.
Yeah.
But if you add back the discounts in the GL, it should tie out.
Exactly. In that case, no adjustment is needed, but the person doing the reconciliation needs to know to compare the subledger total to the net sales figure, sales minus discounts allowances, in the general ledger. It's about understanding how both systems work.
Wow. Okay. You have definitely taken us on a deep dive into some seriously advanced accounting. From building skyscrapers to selling software with support, you can really see how critical it is to get this right, when and how revenue is actually earned.
It really is. And what's fascinating, I think, is how these technical rules ultimately drive transparency. They give us that truer picture of a company's financial health, which, affects big investment decisions, lending, everything. It really raises a question for you, the listener. Knowing all these intricacies now, how might you look differently at those top-line revenue numbers companies report? Do they seem simpler or more complex?
Yeah, next time you hear a company's sales figures, you'll definitely know there's a whole detailed, sometimes complicated process behind that single number. And maybe think about how these ideas could apply elsewhere, like a gig worker or someone creating content online. Who's the customer? What are the distinct promises, the performance obligations? When is that money truly earned and recognized? Lots to think about there. That's it for this deep dive. Thanks for joining us.